You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Wow. That's definitely the theme of Options Playbook Radio this week. We are taping Options Playbook Radio, not at our normal time. We had our big digital conference yesterday that we highlighted in last week's Options Playbook Radio. Hopefully you did attend, but the markets were a little crazy, and if that made you be a little crazy, I understand. They will be available for review on the Ally YouTube channel. So make sure you subscribe to our channel, and you'll get all of the alerts when we post all the different events that we had yesterday. Very good showing, very, very solid questions. Actually, I was surprised at how many people did actually attend the event, considering what was going on in the markets. So we are now, because of that, we're taping Options Playbook Radio a little bit late. It is the 12th. It is a Thursday, and it is around noon Eastern time. The markets are once again rocketing. We had a circuit breaker go off this morning. We currently have the S&P 500 index down 216 points. We have the VIX index above 67. And just an interesting little point about the VIX is, up until the point, the VIX has kind of really set a level that really means kind of fear versus real fear. And that VIX level is right around 50. If you go all the way back to the financial crisis in 2008, a lot of people said, the VIX went to 50. It's really not going to go any further than that. And boom, all of a sudden we're at 100 in the VIX index in 2008, 2009. Now, since that time, the VIX has only hit that 50 level, or came close, not necessarily hit it, 4 times. And now this will be the 5th time since the financial crisis. And the other day when we had 2 events happen, and I highlighted it inside our YouTube channel at the Ally YouTube channel, we talked about a specific trade to do as an alternative to credit spreads, the skip strike butterfly, which we've talked a little bit about here on Options Playbook Radio. But we highlighted the fact that we had a breakdown below the October low, which was the start of a very bullish market. And once we broke through that level, and then we had the VIX break up beyond 50, that was a real scary moment as far as the markets are concerned. And that moment, even though you never know what's going to happen in the marketplace, and here we're just trying to learn on Options Playbook Radio, but when those 2 events happened, you can throw in a lot of other things like the Vance decline ratio and all those good stuff. But those 2 things really kind of sparked something when I looked at them just overall. Now, you can always, volatility has taught people a lot of lessons that, volatility does have a mean, but it doesn't mean that a high volatile marketplace can't go higher. It's just like that 50 level, though, is just kind of a magic number recently in the VIX. So we had the breakdown in the SPX below the October low, the break up in the VIX above that 50% level, and now we have the VIX index trading at 67% implied volatility at this moment. And now the market's moving, so that is a real moving index. Okay, so with that said, we have a high volatile environment. One of the industries, just one of them, that has really gotten crushed is the energy industry, and it's basically oil has been driving down all of the energy stocks on its way down, and the oil ETF that actually owns the commodity is the USO, and the USO recently. Before the big downturn, it kind of gyrated a little bit, but going all the way back to the beginning of 2020 in January, the USO was up above the 13 handle level, came slowly down, traded a little bit sideways and came on down. Then before the big downturn, which would have been the mid-February date, let's say, it traded about 12.5. And then now, boom, all of a sudden overnight, it's trading today for $6.50. So it basically got cut in half, this ETF that tracks that index. And I don't really like to buy ETFs that try to use commodities. They have a lot of high fees. They try to track the values of them, but I don't mind trading them, right? I don't want to buy, if I was going to get long oil, I'm saying that's a big if, once again, not meant to be a recommendation, but I would rather be in one of the oil companies, and I'm not going to name any specific one, but I'd rather own a company than an ETF that tracks the oil stock. I just feel more comfortable with that. It's just as a longer term hold. I would rather be in them than being in something that has a lot of management fees. Okay, so there's heed my first warning. But if you're looking at doing a trade, which that's what we're all about on Options Playbook Radio, is what can we do with this type of volatility? A lot of people are like, sell, 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 sell. But guess what? They were wrong. The sellers in general were wrong. Why? Because high volatility got higher. So it's just that simple. People thought that volatility was at its highest. Now it's quadrupled that, and now we're at 67% implied volatility in the VIX, 100% implied volatilities in a lot of the stocks all the way across the board without earnings. And we're not even into the earnings season, which is just kind of crazy overall. So I'm going to do something fun. As always, this is meant to be a paper trade, but I think it's worth watching in that we have 100% drop in the USO from that point I mentioned around February. Actually, I'll give you that date. February, let's pull it up. I'm pulling it up here on the Ally Invest charts. On that date was February 20th. It opened at 11:30. Did a little bit of a jump up. The high for the day was almost 1150. It was 1143. So we have done almost 100% move to the downside. We're at 650 right now. So conventional wisdom, I don't know if you can call it wisdom, but something like Mr. Fibonacci might say that 50% retracement would be a feasible goal to get back if we got a little bit of a dead cat bounce here in the actual price of oil. And then obviously a good sign would be 100% retracement all the way back to where that big downturn started. So with that said, why not do a long straddle? If we think there could be a bounce back and the long straddle is trading for less than the 50% retracement number, so if we use the number and we use that little blip up that we had on the 20th of February as our starting point, from that point we go from 1150 down to 650. That makes the math simple. That's $5. So a 50% retracement would be a $2.50 move to the upside. So I don't want to pay more than $2.50 if this is my outlook. And now I'm going to do a long straddle because just because it came down 100% doesn't mean it's going to go back up, right? And especially in this marketplace, we got a Fed meeting on the 18th that's going to come out right now. To mention that too, there's just so much to talk about. But looking at the CME Fed Watch tool, that tries to look at the probabilities of the Fed lowering interest rates. They right now say that there is a 100% chance, based off of their tool, that they will lower it. But the big question is, are they going to lower it 50%? Or are they going to lower it 75%? And they're indicating right now that there's an 80% chance that they will move at least a 75% basis points to the downside in the Fed funds rate. So that actually for oil could be a bad thing. The marketplaces are so crazy because the only reason why is that should in theory drive the dollar down, and the oil trades in dollars, and that's usually a bad thing for oil and all the commodities overall. So with that said, though, everybody in the world is lowering their interest rates across the board. If they're not to zero, they're on the way to zero. And because of that, I don't know how that all plays out. So another reason to just be like, something's going to happen. Fed is going to be announcing at this point in time, it looks like the probabilities are extremely high for a Fed rate cut. So that's going to add volatility in the marketplace. So let's do something that says we want volatility. We want volatility. And I think this underlying is going to be fun to do it in. So this is just kind of a fun trade. I want you to look at it. I want you to see how it moves. If you are trading anything on almost any underlying right now, you are trading implied volatility in the options marketplace as much as you are trading the movement of the underlying that you choose. It's just a matter of fact. And we talked about embedding basically a butterfly in your credit spreads, i.e. a skip strike butterfly. We talked about that last week. We've talked about it a couple times on Options Playbook Radio. Last week we did it on the YouTube channel on Friday of last week. Kind of just a little one-off event on the 6th. You can check that out at the Ally YouTube channel. Okay, let's get into the trade. I'm getting a little bit long-winded here. So, market's at 650 in the USO. Let's look at going out, and here's the biggest question here. How far out in time would you like to go? Obviously, time is money. The more you go out, the better chance of the underlying making a big move, but it's also costly. We're seeing the 8-day to expiration, the March 20th expiration, which I want to go out past the Fed meeting if I'm going to pick a date, but the March 20th expiration, the implied volatility of the 650 at the money put or call is around 129% implied volatility. That's crazy. So we go to the next step out. We go out to the 15-day to expiration, the March 27th. That's trading at 115% implied volatility. So on a percentage basis, this is going to be costly to do this trade. But what's really nice about the USO is that it's a $6.50 stock. So we have high implied volatility, but we have a low price stock. So overall, it's not that costly to put on a 1-by-1 long straddle. And I even looked at potentially maybe you sell something to the downside to bring in a little bit of premium. Maybe you sell a put a couple of points down, and that's possible. And I guess I'll leave that as a caveat. But I think it's more interesting going into the marketplace with the big Fed meeting coming up next week, and oil already dropping 5 points down from 1150 down to 650, almost 100%. At one point in time, it was down 100%. Now it's bounced back a little bit. So if we look at that entire scenario, today we're down 43 cents, which is 6%. Move in that underlying stock, down 44 cents at 650 right now as we speak. We are going to do the March 27th expiration, 15 days away. We're going to we're right at 650. You can't get a more at the money option contract than the 650 strike with the stock at 650. I don't think it gets any more at the money than that. And we're going to pay $1.25 for that. So we talked about retracement half the way back from the downturn, and that being a 2.5-point move. Well, this is $1.25. Now, on a percentage basis, it's scary. You're talking about a 20% move that you need either to the downside or the upside on USO. But, like I said, a retracement back to 50% would be a 2.5-point move. Who knows what could happen to the downside in this? And also realize that this is an ETF. It's not like it's an ETF that tracks commodities. So like you can say, oh, to the downside, it's only got 6 points. No. They would do a reverse split in this underlying. And i.e., if you had 300 shares and they did a 3-for-1 reverse split, they increase the price of the stock 3 times, and you end up with 100 shares of a higher price stock, right? So in the ETFs, you can't say, oh, it's trading for $6.50 and it goes to zero. Oh, I only lost $6.50. That is not the case. You could lose way more than that $6.50 because they're just going to keep readjusting that price. All right. So long straddle, simple. I want the market to move. I don't care that it moves up. I don't care that it moves down. As long as it moves $1.25 or more in one direction. What would kill me here is chop. We have 15 days for this to play out. We had a circuit breaker today. We have a Fed meeting tomorrow. The stock has already dropped almost from its highs. Back in the day, this thing used to trade going back, about a year ago in time? Let's see how far out. This thing used to trade for $30. So the last time let me see on this date, I just went out longer on the chart. We're looking at July 2015. July 2015, the USO was trading almost $30. Recent high, not going back to July, actually it was in July again of 2019. The recent high was about $16. And we're all the way down to $6 on this underlying. So why not? This is the only way that I would play oil at this point in time. There are people saying it could go lower. You got the Saudis and the Russians fighting, and then you have good old U.S. producing more than they ever have when it comes to oil. Just a crazy, crazy marketplace. Now, that's going to be our trade. So let's officially make it that paper trade and officially say this is not meant to be a recommendation. This is just a fun one to watch, to check out and see what it does. We're going to go out 15 days in time. We're going to buy the March 27th 650 call option. And we're also going to buy the March 27th 650 put option. The mid price of that trade right now is $1.25. And just to let you know, the actual natural, what you would pay is $1.29. So one of the other things that's nice about a low price stock and low priced option contracts is the bid-ask spreads aren't that wide. They're wide across the entire options marketplace right now because of all the volatility, but in this underlying, they're pretty solid. $125 is my max loss on this trade for every 1-by-1 long straddle that we do. We want the market to at least go in one direction. So you take 650 plus 125, you're at 775 on the upside. Minus 125 is your break even on the downside. And you have 15 days for this to play out. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out. Be safe out there.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.